Okay, good evening, everyone. Thanks for joining us in our Global Markets monthly webinar. For today, we've got our guest speaker, Jay Gragnani, Head of Research and Client Engagement with Nasdaq Dorsey, Wright. And he'll be sharing a little bit of the outlook on the US market and his thoughts on it. So right now, I'd just like to pass my time on to Jay.
Great. Good evening. Thank you very much. And it's great to be here. I am going to go ahead and share my screen and go through some slides, a few slides today, but really talk about what we see going on with respect to the equity markets, very much focusing on the US markets, but we can get in and talk a little bit about other areas as well. I know there is a Q&A session at the end of this, so happy to take any of those questions as they come. But before we jump into it, one thing that I wanted to do is just provide an overview. Some of you, I'm sure, are familiar with the Nasdaq name, broader Nasdaq, whether it be from the stock exchange side, whether it be from the Nasdaq 100 or Nasdaq composite indexes. Nasdaq Dorsey Wright is a registered investment advisor that was founded and based in Richmond, Virginia, in the U.S. And if you're familiar with where Richmond, Virginia is, it is on the east coast of the United States, about middle of the country. So geographically, we're right in the middle of the country. They're just south of Washington, D.C. But nonetheless, the company was founded back in 1987, really as an independent research firm that was designed and set forth to help investors make more informed investment decisions through the lens and utilizing tools that are based in technical analysis. And so everything that we do today is really founded in technical analysis, and very specifically, the point and figure method of technical analysis. And that's the lens that we come through, not that I'm setting out to teach you and talk about everything that I know about point and figure, but rather using that as a springboard, using that as a base of perspective on the markets. And that's really what it's all about, is if we can have some perspective on the market, some objective perspective on the market through price, that can really help in terms of making those investment decisions. And that's really what we're focusing on. We're focusing on price. And through that lens, we were acquired by Nasdaq back in 2015. And so we've been part of Nasdaq for the better part of the past 7 years now. Our main business is our research platform. That's our research tools. That includes access to charts that trade, or stocks that trade all over the world. So while we're focusing on the US markets here, when we think about our research platform and tools and analytics that are available to investors, it really is a global product. We're covering stocks that not only trade on exchanges in the US, but stocks that trade on exchanges all over the world, as well as exchange traded funds that we're tracking and viewing from a technical analysis perspective. As an RIA, we also have an asset management business that we manage over $5 billion on a traditional asset management side of the business. And then an indexing platform where there's about 30 different exchange traded funds that are listed in the US that are based on a Dorsey Wright strategy that accounts for about $11 billion today. And so that's just who we are, who the company is, Nasdaq Dorsey Wright, as a firm that sits and lives inside of the broader Nasdaq business. I've been with the firm for about 16 years now, and focusing on helping investors implement and utilize our research tools and analytics. And so with that said, when we get down to it, when we view the lens, and I mentioned technical analysis, and again, my goal is not to teach a course in technical analysis, but when we think about the markets for a second, well, forget the market. Think about goods that we consume. We think about economics. We think about our day-to-day lives. And at the end of the day, what drives prices of goods, whether those goods are produce that you might buy at a supermarket, whether those goods are shoes that we need to wear on our feet, whether those goods are vehicles that need to be driven. At the end of the day, it's all about supply and demand. And that is one of the most important concepts that I learned in school in Econ 101 was supply and demand. And very simply, if there's more buyers out there for a particular good than there are sellers, then what happens to the price of that good? goes up. If there's more sellers out there for a particular good than there are buyers, what happens to that good? The price has to go down. And if buying and selling pressure are equal, then price has to remain the same. At the end of the day, that's ultimately what drives the price of stocks that trade on the exchanges. No different than the picture you see there at the top. You know, as there's more demand for certain types of fruits and vegetables, the prices of those are going to rise. As supply dries up for those, the prices of those are going to fall. Same thing for the stock market. If there's more buyers out there for a particular stock than there are sellers, then the price of that stock is going to go up. If there's more sellers, what's going to happen? The price of that stock is going to go down. And what we look at technical analysis for is nothing more than a logical, organized way to uncover the imbalances between supply and demand in the marketplace. I can look at a stock and see and tell you if demand is in control of that stock or if supply is in control of that stock. And that's not looking underneath the surface at the fundamentals of the company or who the CEO is or who the board of directors are. It's looking at the price of that security over time. And what the price of that security over time is doing is taking into account the views, the thoughts, the opinions of market participants around the world. We're able, by evaluating and focusing on the price, every information, every data point ultimately flows through and comes out to the price. If you think about a big funnel, if you put all of the opinions, the research reports and the analyst opinions and the hedge funds and the institutions and the retail traders, they're all making investment decisions, and that's all going through that funnel. And at the end of that funnel, what comes out of that is the price. And the price ultimately is the best determinant of value within the stock market. And so that's conceptually, when we talk about the markets, that's really what we're looking at. We're looking at it from a technical lens. We're not looking at it from a macro geopolitical forecasting economic perspective. We're very much looking at it through the lens of price there. And at the end of the day, just like produce in a supermarket, stocks and asset classes and sectors, they can rotate in and out of favor too. And so we need to have a means of identifying when those trends are in favor. And so with that said, when we look at the markets, we look at today, the S&P 500. This is two different scales of the S&P 500 index. And these are looking at point and figure charts. I mentioned point and figure. Point and figure, again, is a one form. There's lots of forms of technical analysis. It's one form of technical analysis that we focus on. And it's something that goes back to the late 1800s. Dorsey, Wright, Tom Dorsey, and Watson Wright, when they founded the company in 1987, didn't create this form of methodology or this form of technical analysis, but it's something that they gravitated to early on because of its simplicity. And very simply, if you've never looked at a point and figure chart, a column of X's represents the price of that security, or in this case, the index is moving higher. As the chart moves lower in a column of O's, that suggests that the price of that index in this case is moving lower. And what we can identify is whether supply or demand is in control of that. Because just like we breathe, we inhale, the chart might rise a little bit. We exhale, the chart might pull back a little bit. And that's going to happen naturally. What's important, though, is what we would call a buy and a sell signal to determine whether demand or supply is in control. We can look on the left-hand side of the S&P 500, and it's a 20-point scale, which means each box, each X or O is worth 20 points for the S&P 500. Well, a couple things I'll point out here, and again, I'm not expecting everybody to be experts on technical analysis, but just providing some perspective on the U.S. markets. Obviously, we've seen some volatility come back into the markets, not just U.S., but globally, as we've seen supply come into the markets here over the course of the first few months of 2020. The S&P 500 peaked in December of last year. It has pulled back as you've seen more selling pressure. The reasons are not necessarily important. There's obviously a lot of reasons for people selling stocks. It could be geopolitical. It could be fear of inflation. It could be any number of things. The reasons aren't necessarily important to us. But it's the actual market action or the reaction to news that exists out there in the market. And then when we see a column of O's move one box below a previous column of O's, and they're highlighted on the left-hand side there with the red boxes, that would be a sell signal. That would indicate to us that supply is in control and there's more selling pressure for that particular security or the broader market in this case. A couple of things to note there. While we saw the S&P 500 pull back, about 12% or so, it got into what many will call correction territory. That is, being down over 10%, but not falling to 20%. The S&P 500 found some notable support down there in the 4120 to 4180 area, and where we're getting that from is wherever the chart stops falling in O's, that's going to be seen as a level of support. So it found some support earlier this year in February, in early March, and traded back and forth. Here recently, we've seen the markets, we've seen a lot of net new demand come back in for the S&P 500 for broader equity markets, to the extent that the chart gave a buy signal at 4,300. That green X there on the chart exceeding the previous column of X's, which would define a buy signal, and has since moved back into a positive trend. So from that perspective, while we've seen a lot of volatility come into the U.S. equity markets this year, we have seen some near-term positive movement and positive breakouts to the upside for the S&P 500. So that is one thing that we're watching today. Things got pretty oversold pretty quickly, and so what we've really seen over the course of the past week or two is more what we would call a reversion to mean. You think about a rubber band, if it gets stretched and stretched and stretched, and the more it gets stretched, the higher the probability it's going to regress back to a mean state. And that's kind of what happened with the equity markets earlier this year. Is they sold off pretty quickly as everything was unfolding. And it got to the point where markets were pretty oversold and outside of more normal or mean reversion. And that's kind of what you've seen here, is mean reversion, but you've seen it happen with some positive upside breakouts on the S&P 500. So I mentioned that to say that we've seemingly gotten back onto some positive, solid footing as it relates to the equity markets today. And not just the S&P 500, but other indexes too, like the Nasdaq 100. And this is a chart of QQQ, which is the Nasdaq 100 Index ETF. This chart, very similarly, you saw it correct. It peaked back in October. The difference here in the Nasdaq 100, given what kind of led the pullback, was a lot of large cap growth. A lot of technology names led the pullback earlier this year. The Nasdaq 100 is very heavily weighted towards growth, and you saw the Nasdaq 100 actually fall about 20%. However, the long-term trend remained positive, and you've seen that support, and I've highlighted it there in red, form some notable support right around 320. Again, this is for the QQQ ETF, around 320, a support level that it's tested 4 times now over about the past year. 3 of those tests have come just in the past couple months. So it's been a pretty notable area of support here. Similar to the S&P 500 chart, you've seen that index move back to a buy signal with the breakout there on the chart. That green box, again, that green box, a column of X's exceeding the previous column of X's at 340 on that chart is what we would identify as a buy signal and suggest that demand has regained control of this particular security, which again, in this case is an ETF tracking the Nasdaq 100 index. Again, the long-term trend here remains positive in a similar light. So if we just kind of take a step back for a second, just look the broad equity indexes, generally still in positive trends, still well below their highs, but has seen some net new demand come back in, and we'll see if there's some follow through. We saw this a little bit back in February, or excuse me, back in early January, where the markets seemingly were trying to grip and find some support, and there wasn't any follow through. So we'll see if we can get some follow through this time, and see if these buy signals will lead to more buy signals going down the road. One thing that's different now, I would say, is just the composition of the market and the general technical health of the big stocks underneath these indexes. And when we talk about these indexes, I mean, they are capitalization weighted or cap weighted, meaning the big companies, the biggest companies, are going to have more influence on the indexes than the smaller companies. So if we just look at the Qs or SPY, which is the S&P 500 ETF, if we look at those two indexes, the top 10 holdings are pretty similar. The big companies are very, very similar in terms of what's inside of there. Apple, right up there at the top, accounts for about 12% of the Nasdaq 100. It's the largest stock there. It's the largest company by market capitalization, by size. And then it's the top in the S&P 500. And as you go down that list, I'll point out a couple of things. One, you'll see under TA, which stands for technical attribute, that's a proprietary score that we assign to stocks based on specific technical criteria. 0 being the weakest, 5 being the strongest. Anything that's 3 and higher is what we'd consider to be technically sound. So again, 3, 4, and 5, you'll see a green dot by that. That means it's technically sound and strong. If it's 0, 1, or 2, you'll see a red dot. Well, 8 out of the top 10 stocks in the Nasdaq 100 are green, which means they're technically strong names. 9 out of the 10 in the S&P 500. So, just from the biggest companies there, the biggest names, the stocks that have the most influence on these indexes, from a technical health perspective, and that's looking at overall trends and relative strength of those stocks, they're very, very strong. And that's a very healthy sign, I would say, for the equity market. Also, a lot of these names, the large cap growth space, technology is a sector. Technology is the most important sector right now for the U.S. equity market. And as it's about 60% of the Qs, it's about 30% of the S&P 500. So, and that's kind of what you've seen this year, is as goes the technology sector right now, that's going to cause and have a really big influence on the equity markets. And that's why you saw the Nasdaq 100 pull back more than, say, the S&P 500. It's got a bigger weight towards technology, but the S&P 500 is still a very notable weight. Where you see massive underweights, and I'll tell you why this is important in a minute, are things like energy. I mean, energy is only 3.5% of the S&P 500, but it's 0% of the Nasdaq 100. Well, if we just look at sector performance over the past couple of years, energy in 2021 was the best performing sector, up over 46%, and so far this year, the energy is up 36%. It has been the best performing sector, not only last year, but so far this year, and so far this year is one of just a couple sectors that are actually positive on the year. The strength within sectors like energy, they're not going to show up in the broad indexes because they just don't have a lot of weight. They don't have a lot of exposure, zero exposure to NASDAQ 100, very little small exposure towards the S&P 500. So, as we're thinking about and we're looking for opportunities outside of just the broad-based indexes, looking for opportunities within some of these sectors that don't have a big weighting can be tremendously impactful over time. If you just go back over the past decade, 10 years, and what we're looking at here on this chart is the best and the worst performing sector, or the sector performance of the broad sectors every year going back the past 10 years. If you were just to look at that on average, the difference between the best performing sector and the worst performing sector in any given year is about 38 percentage points. So on average, 38%. What that 38% means or tells us and tells me is that there's a lot of potential opportunity to find excess return in the marketplace, especially when you get the leadership sectors from areas that are not technology, from areas that are not the biggest weight within the index. Well, technology for years now, prior to last year, was the best performing sector. And even last year was up over 30%. So it still did very, very well. But if you get into an environment where technology is not the best performing sector, that's going to have a big weight on a lot of the broad-based indexes. And you can see, obviously so far this year, technology has been down there towards the bottom, down almost 10% year to date, and that's through basically yesterday. So that's including the rally that we've seen so far this year. But it's really been energy, it's been financials, it's been utilities that have held up a little bit better, even industrials and materials holding up much better than some of the sectors that have really been the leadership sectors for many, many years. The other thing I'll say about energy is if you go back and you look at the bottom of that, basically prior to last year, 6 out of the 7 years from 2014 to 2020, energy was the worst performing sector. And so if we did nothing but avoid energy during that time period, that was tremendously beneficial and impactful as well. And so we focus on where the leadership trends exist and being invested in the strong sectors, but it's almost equally as important to identify where the weakness is and avoid or underweight those sectors within the portfolio. And the way that we do that is very simple rankings. This is a snapshot of a tool that we use that we call our DALI, Dynamic Asset Level Investing, sector rankings. And very much what it does, it's just a snapshot of the strength across the different sectors of the economy. And we're comparing each sector versus each other on a relative strength basis. So we're comparing energy to financials, and energy to technology, and energy to utilities, and we're comparing every sector to each other. That allows us to rank them. How are these sectors performing relative to each other? And then we rank those sectors. And right now, if we look at a snapshot of the sector ranking, so where the strength is in the market right now, not where was it, not where is it going, but right now, where's the strength? Which sectors have the strongest relative strength right now? And if I look at that, it's energy, basic materials are your top two sectors. That is, very different than, say, 2, 3, 4 years ago, where those sectors were down in the basement as crude oil was collapsing. Obviously, crude, raw materials, natural gas, all of the commodity related areas have performed extremely well as the underlying inputs have continued to perform. But right now, energy, basic materials up at 1 and 2. You also see financials up there at number 3, and industrials. One of the bigger themes too here, obviously energy and materials as a commodity resource play. But one of the bigger themes here is really this rotation that we have seen from growth outperforming for many, many years, growth meaning things like technology companies, things like communication services areas. Those growth sectors that have led for many, many years, those have kind of fallen back in the rankings and have given way to more value-oriented sectors. Energy, historically about more value biased sector. Financials, industrials, both generally more value-oriented sectors. You tend to get a little bit more stability out of some of those companies, especially financials and industrials. You tend to get some dividend income type of positions. Those have been the areas that have really shown better strength, better relative strength here than some of the more growth-oriented sectors. I'll also mention, and we'll circle back to this in just another minute as well, is those are sectors, energy, materials, financials, that tend to be more positively correlated to interest rates. And I'll say that another way. As interest rates go up, it can negatively impact things like bonds, is the biggest. But from a sector standpoint, energy, materials, financials, those sectors tend to do better than others while interest rates are going up. And obviously, interest rates have been going up here recently. So it's not a surprise or coincidence that you're seeing some strength there from those areas. I mentioned it, just from the kind of style perspective, large cap growth really has been the dominant area from 2017 to 2021. And really, if you go back into 15, 6 out of that 7-year stretch, large cap growth was the best performing area of the markets. If you just put your money in large cap growth and did nothing else, you massively outperformed the S&P 500, just broad equity benchmarks. That has been flipped on its head a little bit, here over the course of the at least so far this year, as you've seen large cap growth pull back more so than some, down about 10% this year. And it's been some of the more value, even large cap value is currently the one that has held up the best, small cap value up there as well. But it's this kind of speaks to that dynamic of value certainly coming back into favor after a very long stretch of large cap growth being dominant. So, we'll continue to see how this plays out. We'll see if large cap growth can regain its footing, but right now it's certainly a lot of strength in the value areas. Not to say that there's not positive action, as we mentioned with like the Nasdaq 100 QQQ. That's very much a large cap growth index. You're starting to see that turn the corner here recently and return back to some buy signals. So, just a couple other slides I wanted to touch on today as we kind of take a step back for a minute and not just focus on U.S. equity, but focus on asset classes really around the globe. And our Dolly, or dynamic asset level investing tool, is really designed to provide a map of the market across asset classes and within asset classes. So we looked at the sector rankings for within U.S. equities, but if we take a step back for a second and say, okay, before we focus on equities, are there stronger asset classes out there? Should we be invested in bonds more so than stocks? Should we be in cash more so than stocks? Well, right now, commodities is the #1 ranked asset class. And you see that to the left-hand side there. Commod is #1, is the strongest asset class from a relative strength perspective. Domestic or that's US centric, but so that would be US equities is sitting in there #2, and then comes non-US equities in there at #3. And then you have fixed income, cash, and currency down in the bottom. So a couple things I'll mention there, and how this is useful and how we view this is, first and foremost, that #1 ranked asset class is something that we put a lot of importance on in terms of building portfolios and allocating to them. So commodities being #1 is important. Not too surprising, again, given what we've seen happen with the likes of crude oil that went to, it's up $113 a barrel roughly now, got as high as 130 recently, pulled back, but it still has a very positive trend with respect to crude oil. But the strength within commodities hasn't been relegated to just crude. Crude is the biggest, the most widely followed, the most widely talked about, but you've seen strength from commodities really across the board, from agriculture to base metals and industrial metals to copper, and even going into some other energies like natural gas and precious metals like gold as well. So really you've seen a lot of strength across a lot of different commodities, and so you see that up there at #1. That's also why you see energy and materials on the sector perspective up there, because of those the companies benefiting from that. U.S. equities is #2, and non-U.S. is #3. And if I look at that, not only is commodities #1, but the three more offensive or growth asset classes are in the top half of the rankings, where the three more defensive areas are in the bottom half of the ranking. And that's just that's a general statement about the risk appetite for investors right now, is that they certainly seemingly are more willing to take on risk and looking for growth as opposed to just stability. And with interest rates doing what they're doing, I mean, fixed income is, as interest rates continue to move higher, fixed income bonds are traditionally going to lose value. So again, not too surprising to see that. But commodities and equities, those are the two strongest areas of the market right now, while cash and fixed income would be seen as your weaker areas. And just kind of rounding things out, we talked about interest rates, a lot going on, a lot of eyes here in the U.S. on the Fed and what the Fed's going to do with interest rates. There came out and hiked 25 basis points recently. By all accounts, the Fed seemingly, I think that the latest consensus is that the 7 total rate hikes in the U.S. this year, after years and 30 years of generally declining Treasury yields, and this is just the 10-year U.S. Treasury, still relatively low from a historical perspective, at hovering right around 2%, just above 2%, has moved up sharply here really over the course of the past few months as interest rates starting to go up, inflationary signs coming in, the Fed hiking rates here in the U.S. and signaling that more is coming. This move in interest rates is certainly very, very real, and it's for years now it's not been a if but when discussion of when interest rates are going to rise and how that's going to impact other areas of the market. And we've kind of touched a little bit throughout. Commodities move higher. That happens generally during inflationary environments as interest rates are moving higher. So commodities typically provide have historically provided a decent hedge against inflation. Similarly, stocks have too. Stocks in general have been more inflationary hedging than say things like fixed income or even cash. Because so that's just something to keep in the back of your mind. I think is a lot of these headwinds and tailwinds that we're seeing through the market today, a lot of that can be kind of tied back to general inflation, interest rates, and the likes going on from there. And so I'll kind of round out with this, and then turn it back over, Jonathan, to you to take questions. But when we think about our investment process, number one, it is very much systematic and disciplined. And if we can be disciplined to our process is utilizing technical analysis and identifying leadership trends from a relative strength perspective. If we can be disciplined in that process over time, that's going to what we found to work much better with an objective lens to the equity markets. And so the only thing I would leave you with is having a discipline, finding a discipline, and sticking to that going forward is something that we found to be tremendously impactful. And if some of the information we talked about resonated with you, and you think you might like to incorporate it, I'd encourage you to reach out to us. Happy to take any questions, calls, comments. We do offer a free trial of our research platform if that's something that you're interested in doing. We can certainly follow up more on that later. But with that said, thank you very much for your time. I appreciate everybody taking time out of their evening to join us and listen to our call. And with that said, Jonathan, I'm going to turn the call back over to you.
Great, thanks, Jay, for the very insightful sharing session. I guess in the meantime, I've got quite a number of questions on my own. They're a little bit more macro in nature, but we can just have a little chat about them. I noticed in your slides that XLF, the financial sector, is one of the strongest based on your DALI or rather asset class recommendations. But I noticed it's only up about 1%. Even though in a rising interest rate environment, it should by right be performing a lot better than that. Do you have any comments on this, or do you see this as an opportunity for investors?
Yeah, you're right. I mean, financials right now is the third ranked sector. It's green, so it's something that we would have more of an overweight position on. And as interest rates rise, I mean, the idea there with financials, as interest rates rise, especially the banks have the ability to lend money out at higher interest rates, have higher margins, and then that leads to typically higher profits and stock prices go up, right? And so that's kind of the theory and the thought behind it. I don't know that you've quite seen all of that flow through just yet, but you've certainly seen the financial sector have a little bit more stability. While it may not have gone up a ton right now, it's had a lot more stability than some of the other areas of the market. But yes, I would say financials right now is a sector that you could consider as one of the leadership sectors right now.
Great. I guess another question. We've seen quite a big sell-off from, I guess, the end of last year up to maybe a couple of weeks ago. Can you kind of comment on what the risk-off sentiment was during that period? Was it inflation? Was it worries about with rising interest rates? Could it be the Russia-Ukraine conflict that piled on a little bit more of the selling? Just any comments on that?
Sure. Yeah, and I'll start with the idea that when we evaluate the markets, because we're doing it through a lens of technical analysis, the reasons why to us aren't necessarily that important. It doesn't matter why someone might be selling their shares of Apple or selling their shares of Tesla or whatever it might be. It's for us, it's that they are doing it, one thing or the other. With that said, there, certainly coming into this year, you had stocks at all-time highs hitting last year, having a tremendous run. And so I think really there was a confluence of factors that really led to investors de-risking the portfolio a little bit, and probably a lot of it had to do with just general uncertainty around what was going to happen. I think inflation was very much a big concern coming into the year. The initial inflationary numbers that came out last year and began to come out last year as we started to see inflation pick up was that it was going to be transitory. Well, that didn't actually prove to be true is that, inflation is here and real, not necessarily transitory, just as a result of the pandemic. So certainly uncertainty around inflation was one of the reasons that was pointed to very specifically. Earlier in the year, you had a lot of regression from COVID and the variants coming out there, and again, uncertainty around what was going to happen with that. And I think the general uncertainty around all of this stuff, whether it was geopolitical, whether it was COVID related, whether it was inflation, interest rates related, there was just a lot of general uncertainty, and investors were sitting on in theory portfolio positions that are at all-time highs, and probably saw some profit taking to some extent at the beginning of the year. So again, I think the reality is there's lots of different reasons that investors were looking out there and saying, hey, I'm going to sell my shares, I'm going to take some profits, and I'm going to just sit on the sidelines for a minute until I get a little bit more clarity in terms of what's going to happen with everything, with all of this stuff. There seems to be, at least from the inflation side and the interest rate side, the U.S. Federal Reserve Federal Board has come out and provided at least a little guidance. And so they hiked rates 25 basis points. They're forecasted they will probably do it another 6 times this year. And so that, I think, for investors just provides a little bit of clarity, at least in terms of how inflation right now is going to be handled from the interest rate perspective. And then as we continue to see more clarity around COVID response and geopolitical conflicts, you will probably see a little bit more guidance from the equity markets there.
Great. Thanks for your comments on that. I guess the last question before we take on some of the questions from the audience. Looking at these rankings, energy is number 1. Can you comment a little bit about how you guys derive this particular ranking for energy? Is it just past performance? Because historically, it's always been at the bottom of your rankings, or at least for, I guess, 6 of your last 8 years or something like that. Yeah. Just a little bit more color on that would be great.
Yeah, so I'll just, this is kind of the chart that you're looking at, and your comment of energy has, prior to last year, really was the worst performing area of the market. And, not too surprising during that time period, crude oil, energy was low. But when you look at the markets, and I mentioned it earlier, is when we think about sectors, historically, you don't see runs that long. I mean, you don't see a sector down at the bottom for 6 out of the past 7 years very often. Even on the other side, technology, the best for any number of years. And those, because sectors take turns, they rotate in and out of favor. You might see a couple years where sectors lead, and then somebody else takes the baton and moves forward. And so while right here we're looking at just pure price performance, when we go and we apply that to our Dolly sector rankings, what we're doing is we're comparing the price movement, price performance of each sector versus every other. And so it's like a big tournament. It's like a big sports tournament where we look at the energy sector and we compare it to financials and say, how are you doing relative to the financial sector? If you're beating financials, then you're going to move up to the top. If you're not, then you're going to move down. So each sector gets compared to every other sector out there. And then we have the ability to rank them. Now, the way that we actually go and do it, I can mechanically walk you through the process. It's done through the lens of the point and figure methodology. So I'll just use as an example, we take XLE, which is the Energy Select Sector Spider. We compare it to XLK, which is the technology sector ETF. And we take the price of one, we divide it by the price of another, and we multiply that number by 100 just to move the decimal place over. That gives us a ratio. It gives us what we call a relative strength reading. That reading we then take and plot it onto a point and figure chart. And so while we talked about point and figure charts back here as plotting the price of, say, QQQ, the Nasdaq 100 ETF, when we do that calculation, take the price of one divided by another and plot that reading, what we're doing is we're plotting a relative strength calculation. So instead of the actual price, it's a relative performance number. But then we look at it through the lens of the point and figure methodology. So if energy is outperforming financials, then we'll see a chart that looks like this, where that chart has moved back to a buy signal, a column of X's exceeding the previous column of X's, and that would be one win for energy. And we go on and on down the road through that relative strength ranking process to ultimately derive at a number or a picture that looks like this.
Great. Thanks for that. We'll take some questions from the audience right now.
Sure.
So we've got this question. Hi Jay, do you think that the past week's move up on the S&P 500, Nasdaq, and Dow Jones is maybe just a short-term bounce, or do you think the uptrend will sustain in the short to medium term?
Yeah, I would say I think last week, what you saw is one reaction to some of the Fed announcements here in the U.S. But you saw more of a mean reversion, a regression back towards mean. And again, what I mean by that is things sold off so quickly that just long-term averages suggested that the markets were oversold. They had sold off quickly. Probability was that things were going to revert back towards mean, and that could have happened one of two ways: either the stock market rises, or time goes on and that mean point comes down. And you'll notice on the left-hand side there of this chart, you see a midpoint of 4,400, and that is kind of what's considered mean from that perspective. On the right-hand side, you can look at it, and this might provide a little bit of perspective too. Here is you see a top, a mid, and a bot point. So mid again is at 4,400. That's basically a 10-day moving average, a 10-week moving average and then the top is 100% overbought, so about 3 standard deviations to the right of mean. The bot is oversold. And if you picture a normal distribution bell curve for a minute, you turn it on its side, and that's what that top, mid, and bot point means. So that midpoint is dead center of that bell curve. Okay. If you go to the bottom, the closer you get towards the bottom, the closer you get towards that 3 standard deviation move to the left, and very, very oversold. Conversely, if you move up to the top, that's your 3 standard deviation move to the right and very overbought. So mean reversion happens two ways. If you get oversold, chances are things are going to bounce in the near term. If you get overbought, things are going to revert back to mean. And so I think some of what you saw is just the markets get oversold very quickly and revert back towards mean, and that's kind of what you've seen now. You see back in February where you got halfway down, didn't get all the way down to the bottom, but you got pretty notably oversold there back in February. So I think that is certainly part of what we've seen here over the course of the past week or two, is a reversion back towards mean. Now, with that said, the reversion back towards mean has created some positive development on a lot of these charts. You've seen buy signals return to some of these longer term indicators. You've seen the S&P 500 return back to a positive trend. We've seen some other indicators return back towards positive positions for the first time in a while. And so while I think it certainly was a mean reversion, I think there's some more positives that have come as a result of that, as opposed to just seeing this kind of near-term fruition. So yeah, so I would say, generally, I would see that what the action that we've seen over the course of the past couple of weeks has been a positive sign. With that said, on the S&P 500, I would say a reading of 4,600 would be added confirmation to that thought. And basically what that 4,600 level would do is exceed that high from February of this year. So that would be another positive sign. What you've also seen, it's kind of nuanced, but when we sold off in February, that was kind of the bottom. Then we rallied a bit at the end of February, sold off again in early March, and that sell-off in early March didn't see the S&P fall as low as it did back in February. So you had this situation that created a higher bottom, meaning there wasn't as much supply, there wasn't as much selling pressure driving the market down as there was the previous time. So you rallied a little bit, and then again, you pulled back a little bit more in March. Again, you created this higher bottom again. And so you've had this situation as the market is trying to find a bottom, find some support in here, it's doing so, and pullbacks have come with less severity and less participation to the downside. So not only have we seen that chart move back to a buy signal, but it's happened and it's come as supply has seemingly been drying up here over the course of the past couple of weeks.
It's tough to be a bear in the market, I guess. All right, next question. Hi, Jay. Based on your experience, can you share your view of the Nasdaq being manipulated by market makers? And as retail investors, what are the three main things that we should be aware to make sound decisions?
Sure. So I'll speak to the, I guess, the Nasdaq, index and just general participation amongst market makers, high frequency traders, institutions, and the likes. And I would say that for the retail investor, more market participation is better. And high frequency traders, they're trying to pick off 1 cent, 2 cents, 3 cents here and there, and do it in a big way. For the average retail investor, I'm not in it for a penny or two. I'm in it because I want to own something for the long-term trends. But the more participation in there, the more liquidity that is persistent and prevalent, the easier it is to get in and get out as a retail investor that you want to. And so one of the best things that I think you can do as an investor is focus on the market action. Don't worry about the why. Don't worry about who's doing what. Focus on what the market is doing, as opposed to trying to tell the market what we think it should be doing. It's all too often that we get into scenarios and say X happens, therefore Y should happen. But for whatever reason, it doesn't. But if you just look at the price, it's very clear that that's not happening. And so, that's why we focus so much on price. We focus so much on evaluating trends of individual stocks, of Nasdaq 100 index, of stocks that are in the Nasdaq 100 index. Focusing on that trend can be so important. And then at the end of the day, from an investing standpoint, having a process, having a discipline, having a religion, if you will, and going looking at that every single day and being disciplined about that investment process. Again, we look at technical analysis and momentum, trend following, relative strength, all of those words. That's just something that we found to work very well. It's not to say that's the only thing that works well. There's many investors out there that are almost opposite and very much 100% value investors. And that has seemingly worked here recently, but value is out of favor for a long time. So, but over time, if you remain disciplined to that process, that methodology, that's ultimately what we found to work the best over time.
Great. Yeah, so we have another question here. I guess it's a bit more macro compared to what you guys do. TA definitely helps to quieten down the noise that you get from everywhere. This question is, are we out of the woods? There's so many headwinds from high inflation, the Fed shrinking the balance sheet, your yield curve inversion. Just maybe a little bit of comments on that as to how you guys look at it compared to the technical analysis that you guys use to make decisions.
Yeah, it's a great question, and certainly something that's on everybody's minds of what's going to happen and how is that going to impact the markets. Again, we don't focus on the why. I'm not worried about the why. I'm not worried about why people are buying Apple or why people are selling Apple, whether they're concerned over inflation, whether they're worried about the balance sheets of the Fed, whether they wanted to go buy a new car, and it doesn't matter. What ultimately matters is what happens with that price. And with that price, what we can do is we can then evaluate where the markets stand today. And so if I just look at it and I say, where does the market stand today? Right now, I would look at the charts of the S&P 500, the charts of the Nasdaq 100, and say we are certainly still well off highs, but overall trends are positive for these broad indexes. Demand is in control right now. We'll see. We saw this very briefly play out back at the end of January and didn't see any follow through, as we mentioned earlier. We're now seeing that support held, at least on the Nasdaq 100, doing so within a positive trend and returning back to a buy signal. So we'll see if we get some more follow through. If we don't, then we'll go from there. But you've seen this rally here in the Nasdaq 100 get above that high from earlier this March. So I think that's initially a positive sign. And then again, it's similar to the S&P 500. If the QQQ gets up to 375, it'll exceed and move back above that February high. So that's a positive thing. So, I think that's a long way of saying, I think if I just kind of lay out everything for the market, there seemingly are more positive developments that have come as a result of the recent market action than there are negatives. It's not to say you can always find something out there to confirm your belief, but if we kind of put our emotions aside for a minute and just lay everything out on the table, have to certainly look at it and say there's still generally more positives than there are negatives for the markets right now.
Great. Yeah, I guess positive signs are always a good thing for all the retail investors, especially. Next question on a little bit on China. I'm not sure if you'd be comfortable answering this, but Chinese ADR stocks listed in Nasdaq in risk of being delisted?
Yeah, I mean, that's not something that we're super focused on right now, and I don't know that I necessarily have a comment in terms of what's going to happen. I know there's lots of discussion there, but I'm happy to comment on just the Chinese equity market in general. Complete opposite of what we've seen within the U.S. equity markets. Chinese equity markets for the better part of the past year plus now has been in basically a negative trend, has been falling since peaking back in February of 2021, which is and not just China, but non-U.S. has faced some headwinds from a couple different perspectives. One is the U.S. dollar has strengthened quite a bit. It has put some pressure on currencies around the world, which ultimately has provided a headwind for some areas like China. There's obviously more going on there. But if we just look at what's happened, if I just look again at what the charts show for Chinese equities in general, long-term trend is still negative, and you're still seeing that those equity securities come under pressure. So we'll have to wait and see what happens with the rest of it.
Thanks for that.
Yeah.
One more question from the audience. This is quite an interesting one. In your view, is the 60-40 stock bond strategy still valid? Is it still valid?
Is it popular? Sure. A lot of people use it. Is it something that we espouse to or something that we adhere to? No. Especially right now, interest rates are rising. Do I want 40% of my portfolio to be in bonds where that is going to just cause a massive drag on my portfolio? Probably not. And so, there's lots of advantages. The past 30 years, that 40% of your portfolio that was in bonds has benefited from a generally declining interest rate. If interest rates are going to rise, which they have, and do so in a meaningful way, they're still low, but by all indications, interest rates are going up and they're not stopping anytime soon, then that is going to cause a big drag on your portfolio, and that's a big chunk at 40%. That's supposed to be stable within the fixed income. So I think that's a real concern and consideration if that's something that you're looking at today.
I guess that's a pretty good answer to a very common question, especially nowadays or in recent times. When the equity market is just really outperforming the bond market, it almost doesn't make sense to hold any bonds in your portfolio.
Yeah, I mean, I think you have to look at it. Why are you holding bonds? Are you holding them for the stability, or are you holding them for income? If you're holding them for income, there's certainly other places to get income from. If you're holding for stability, well, again, if interest rates going up, those bonds are not going to be stable. They're going to go down in price.
Yeah, definitely. So I guess with that, we've come to the end of our Q&A. Just want to thank Jay for spending his morning and sharing to the audience, of his company and his own outlook on the U.S. market and the market in general. I'll pass my time now on to Darren to have to kind of wrap us all up. Thank you. Thanks, Jay. Thanks, Darren. And thank you, everyone, for spending your evening with us. See you.
Thank you.